Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Mike Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. And typically joining me today would be Michael Becker, but he is closing another transaction. So good for Michael, and also good for us because we have Les Meisel in the house.
Thanks for having me, Paul.
Also with Old Capital. Today we're going to talk a little bit about community banking. And we brought on another lender to have you talk with and listen to a little bit about community banking. And community banking is kind of basic banking. And, grandma or your aunt bring money in so they can get a rate of return on it. The community banker kind of turns it around and lends that money out. And so we're going to talk a little bit about what are some of the rules with community banking? How does that work? Will they help you get you into the multifamily business or the commercial real estate business? A little bit about what the structure looks like. And so today we brought in one of our community bankers to kind of talk a little bit about community banking. So we've had Fannie Mae on Freddie Mac, and the Freddie Mac guy his name's John, and one of our large regional banks, his name is John, and then the community bank, this guy's name is John. And I guess we just
glad to be just one of the Johns.
It's crowded in here.
Yeah, so we have a bunch of Johns, but those are their real names. So John, thanks for coming in. We appreciate it. So everybody meet John. John, meet everybody.
Thank you, Paul. Happy to be here.
Good deal. So John, let's talk a little bit about community banking first, and then I want to know a little bit about your background.
Well, I'm a 35-year banker. I've worked in large banks, middle market banks, and also community banks. I've spent most of my time in community banks. I find I like the flexibility of community bank better than a large bank. And the last 15 years, I've done a lot of real estate and a lot of multifamily loans.
So where are you originally from? And tell me a little bit more about your background.
Well, I'm originally from the Minneapolis area, and I spent first half of my career as a commercial industrial lender.
And first of all, what is a commercial and industrial lender?
Commercial industrial lender is basically a business lender, someone who makes equipment loans and lines of credit to businesses, manufacturers, wholesalers, that type of thing.
So based on like inventory, you provide
Correct.
the
We'll do an
financing.
advance rate against accounts receivables and inventory, and typically it's seasonal. The line of credit will go up and down based on how strong business is at any particular time.
All right. So you made a transition over to real estate lending?
In 1997, I moved to Texas and quickly learned that I had to learn real estate lending. With all the growth in the Dallas-Fort Worth market, there is a lot of real estate lending that goes on here, and there was lots of opportunity.
Good. So let's talk a little bit about what the difference is between being a community lender, say a regional lender, and say a national lender. Those are three of the different lenders. Give me an example of what a community lender is and the other ones.
Well, as you mentioned earlier, in its simplest form, a community bank is a bank in the community. We gather deposits, local deposits, and then we turn those around and lend the money back out, and hopefully we try to make a profit in doing that. Our focus is on a certain community. In this case, we focus mostly on the Dallas-Fort Worth market. We like to think we know that market very well. We know the neighborhoods. We know where the growth is. We know where the growth is not. A national bank, they might be headquartered out of state anywhere, and they have decision makers who are located out of state, and they don't know the local market as well as we know it.
Yeah, and you would also probably find that for a regional bank too. So typically, community banks are anywhere from $25, $30 million in assets and deposits, all the way up to maybe $300, $400, $500 million in deposits. Some can be up as $2 to $3, $4 billion in deposits. The regional lenders, which kind of are just gross area of the country, are going to be $400, $500 million and up to 15, 20, $30 billion in asset size. And then the national lenders like Wells Fargo or Bank of America or Chase, they're going to be multi-billion dollar banks. So you like the space for the community lenders, and tell me a little bit about why you like that space.
Well, as I try to explain it to clients, is the big banks, someone in the home office designs a loan product, and that's just what they call it, is a loan product. And they'll sell you that product, and you have to take that product just as it is. This is the pricing on this type of deal today, and that's just the way it's going to be. Whereas community bank will look at the individual loan request, look at the strength of the property behind it, and look at the strength of the borrower. And we're going to modify our pricing and some of our other terms based on those particulars of that particular deal.
John, can you tell me a little bit, based on that, a little bit how the approval process varies in a community bank versus some of the other banks?
Sure. Some of the big banks I've worked for have centralized committees located out of state. In some cases, the loan officer will do a loan presentation or write-up which explains the deal, and they'll ship it off to Kansas City as an example. And the people in Kansas City will read it and render a decision, and the loan officer might not even be involved in that process. Versus a community bank, such as the one I work at now, I put the loan presentation together. I go to the loan committee. The loan committee consists of local people, not only local employees of the bank, but also some of the local directors. Our particular bank, we have a couple local real estate bank experts on our committee, and they help us make that decision.
So it gives you a little additional flexibility in market.
Certainly, and an opportunity to explain the deal, sometimes beyond what's written, and to help them understand it, answer their questions.
Yeah, community banks are a little bit more entrepreneurial. I mean, they're almost like sole proprietorships. It comes down to the credit committee and the people on the credit committee and how flexible they are to get a decision. But they are truly in the thick of the community and see what's going on. Tell me a little bit about the structure on how you guys do it. You guys do a write-up on the first part of the deal? Because in the community bank atmosphere, like a regional or a national bank, you can't make that decision yourself. That actually has to go to the credit committee. So if a borrower comes in and talks with you, it's really not you making the decision. You are pretty much just the front side of the credit decision maker. So tell us a little bit about how that works.
Well, as I mentioned earlier, I've been doing this for 35 years, and I've never been in a situation where they just leave it up to one person to make their own loan decisions. It's just getting too difficult these days. You have to make sure in that loan presentation that you do certain things for compliance reasons also, because the people who are reading that loan presentation are not only going to be the people on the loan committee, but then you've got examiners, whether they're state, federal, OCC, both come through. They're both going to read that loan presentation, and you want to make sure you have enough information in there so that they understand the deal, and so they like the deal as much as you like the deal.
What would be typical things that are going to be in your initial write-up into the transaction? And do you show that to the loan committee on the front side of the deal, or do you show it to kind of a senior vice president to try to get an idea whether you guys have an interest in doing the deal on the front side?
I'll generally talk with whoever I'm reporting to about the deal early on to make sure that we're on the right track with it and just get a different set of eyes on it, because sometimes I've seen something they haven't seen or they've seen something I haven't seen. My typical process is I'll look at the project first. I want to make sure the project, the economics of the deal work. Primarily, I want to make sure the property is going to cash flow. My goal in life is to never take a piece of collateral back and never get a borrower in trouble. So I want to make sure there's plenty of equity in the deal and it's going to cash flow. And then we're going to also look at the borrower who's behind it. Do they have the experience to do this kind of project? Are they new to it? And if there's a bump in the road, do they have the liquidity to back it up and get us through that rough time?
John, Paul mentioned earlier, very briefly, and maybe you could spend a few minutes, of one of the requirements usually in a community bank is having an operating account with the bank. Can you just tell us why that is such a key and an important aspect of the transaction for a community bank?
Certainly. As we spoke earlier, basically a community bank takes in deposits and we lend them back out. So deposits become more important to us sometimes than a loan, because if we don't have any deposits, we don't have any money to loan out. Plus the fact that if I'm doing a real estate loan for you, I would expect that you have the deposits with us also. And it allows us to track what's going on a little bit. If there's some bumps in the road, or If the account is in an overdraft situation, we want to know about that. And so we can find out, is there an issue there that we need to address?
Okay, thank you.
So, just hammering that a little bit more closer to home, some people ask us, why do I have to bring my operating account to the bank? I have it at Big Bank XYZ. They're doing a good job. I want to keep it over there. And I always go back to them, is Big Bank XYZ making you this $7 million loan? No, it's John's bank, and John's going to require the depository relationship put in there. In fact, we don't want the depository relationship. We want to get more of your relationship business over to us, whether it's a personal savings account or a checking account. I mean, everybody's going to pay about the same in terms of rate of deposit, whether it's 0.25% or 0.5% if they're paying that. But you want to do business with a community bank because they're the ones who are actually going to lend you the money. Not just this one transaction they want to lend you and the next transaction. They are relationship-oriented lenders. Relationship-oriented lenders where Fannie Mae, Freddie Mac are not. They're just looking at the transaction itself. Their collateral is really based on the property, the asset. They're not really backing the individual, where John's going to be a little bit more flexible, that he's going to help you get you into the business. So he's going to take an interest in the property itself, but he's also going to take, moving across the underwriting guidelines, he's going to be a recourse lender. So John, tell us a little bit about being a recourse lender. What does that mean to you? What does a recourse lender mean?
Well, before I answer that, let me follow up with that. I never go into making a real estate loan with the idea that this is just a transaction. It's going to be part of a relationship. And once we've done the first deal, it makes it easier to do the second deal. And if for some reason we have to tweak the first deal or the second deal or get a little bit of outside the parameters, it's much easier to do that if you have some experience with that client, and that's part of that relationship.
And then for me to add on to that is that once John makes you the first loan, make sure you pay it back, because the second loan becomes much more easier, and so is the third one too.
Certainly.
So talk a little bit about recourse.
Recourse, we are a recourse lender. Most community banks are. We expect that if we're going to put 70, 60, 70% into the project, that you're going to stand behind that project also. And if there is some kind of bump in the road, as I say, that you'll be there supporting it. As I mentioned earlier, I never want to get a piece of real estate back. Most cases, if there's problems, I want to make sure that you're there working with me to correct whatever problem there is.
Yeah, recourse on some of these transactions. So the bank is going to take an interest in the property itself, but it's also going to take a financial interest in your balance sheet. So John looks at it as, a partnership. He is your largest partner in this transaction. So he's going to be your best friend in the transaction. So because he's going to give you, 65, 70, 75% leverage into the transaction. So you go out there and acquire the property and rehab the property. I mean, as a community banker, are you guys long-term lenders? Are you medium-term lenders? Are you short-term lenders? Tell me a little bit about what your box is and what would be a typical transaction that you would want to see come to you.
I would think that we're probably medium-term lenders. Typically, because we're using customers' deposits, we can't fix the rate for more than 5 years at a time. Even now, we're kind of stretching things because we don't have anybody put CD money in for 5 years. We're taking some interest rate risk there. And we're also, when we make a loan, we're making a little bit of profit, and hopefully you're making a 20% profit or better on the deal. So we don't want to have a lot of risk. You're taking the risk, but you're also getting the return.
So tell us a little bit about going back to recourse. It's joint and several, and what does that mean?
Well, joint and several just means that if there's more than one guarantor, everybody's standing behind it. And one person isn't standing behind it for $50,000 and the other one person standing behind it for $100,000. Everybody's standing behind it for the full amount.
So if someone were to be assigned as a guarantor in the transaction, regardless if they had maybe a 20 or 25% ownership in the deal, and you had a 50% ownership in the deal, everybody would come in to be 100% guarantor
exactly
of the transaction. And that's a little bit of the difference between, say, a recourse lender like John and a non-recourse lender like Fannie Mae. John is a short-term lender, between 1 year up to about 5-6 years. He's not a long-term lender. His rates are going to be a little higher than a permanent lender, but he's going to give you the greatest amount of flexibility. Where Fannie Mae looks at current cash flow and where the property's at, they'll do a snapshot of the property. John's going to kind of take a look at the transaction as a movie. Where is it at today and where is it going to? So he'll look more favorably on a pro forma if you can back up the pro forma. So an example would be like if you were looking to acquire a property that needed some rehab, and we wanted to make sure that when we did the transaction that property was going to be valued a lot higher than what it was when you bought it, based on the amount of brand new equity you brought into the deal, the rehab that you put into the deal, where the market was. So John's going to be a lot more flexible to lend you the money up to, say, 70 or 75% based on pro forma. John, can you talk a little bit more about that? What does that mean?
Well, as far as the flexibility goes, I think of examples are if you buy a group of buildings or a group of houses or something like that, and you go to a big bank and you get a cheap mortgage put on that. If you want to sell one or two of those buildings off because someone's offering you a great price on it, likely they won't do that. They won't release the property. They say, this is the deal we did and we're sticking to the deal we did. I'm going to release that deal as long as I continue to be in a good collateral position, a good cash flow position on the property.
And a lot of our listeners are making the transition, and that's a good point. They're making a transition from being single-family owners to multifamily. And they've probably had experience with a community bank before with single-family. Can you just kind of briefly explain a little bit of the difference and a little bit difference in the process for the two?
If you're going out and you're going to mortgage your home, it's pretty easy these days to go online and you do checklist lending, you fill in the form, send in the paperwork. They're doing thousands and thousands of those transactions probably every day. And that system is a very refined system and very regulated, know what they want. Again, with a community bank, when we're doing a multifamily deal, we're going to hold that loan in our own portfolio. So we want to decide whether that's a good loan for us. And that may, in almost every one of these deals, is unique in some sense. And so we're going to look at different things or look harder at different areas based on that particular loan. So the process is going to be different. I'm going to ask you for paperwork, and that paperwork is going to come back and generate new questions. And we're going to do some market research and look at the property, and that might ask some new questions. So it's much more of a relationship-driven process. I have to be the partner in this deal, and we want to work together and talk about these issues. If there's something that comes up, we need to address it together.
Yeah, Les brings up an important point. When you get a commercial loan, it's not like a residential, Fannie Mae loan where there's a bunch of paperwork to fill out and you push it over to the lender and they do an appraisal and things like that, and it comes back whether it's an approval or not. This is more of a negotiated relationship transaction. Remember, when John makes a loan onto the property, he is the one responsible not only for originating the transaction and getting it approved, but also after the loan closes, he's the one that's responsible for the relationship with you. And so he wants to know a little bit more about what you do, and he wants to continue on in getting more financials from you on a going forward basis. Where after like a residential home loan, you do your financials one time and the money's out the barn and you'll never have to do updated financials. Well, with John, you're going to have to send either quarterly operating statements or rent rolls, and every year you're going to have to update your financial statement yourself, and you're also going to have to probably send over your personal tax returns. So don't get boondoggled into thinking that you only have to do it one time. So there are some more steps when you do a commercial loan that you have to not only figure out that John is part of the decision. He's not the decision maker, but he kind of knows what the playbook that the decision maker knows. He's going to be the person who's going to be the advocate for you. Tell him the truth. And one of the things that I say, which is a little bit different for other lenders, is that John is a direct partner with us. And when we see the opportunity, when we do talk with clients out there, is we bring John in on the front side. We want John to have the relationship with you. It's just not us doing the paperwork, putting it all together and kind of figuring out. We bring John on the front side when it's a community bank transaction. Again, that is an acquisition typically with a rehab component into it, onto a, let's say a $3 or $4 million transaction with, $500,000 in rehab into the deal. That's where John is going to be at, where John's going to help you get into the business. He's going to structure the deal that he's going to kind of put you into the driver's seat if you have no previous experience. He's going to structure it, well, we may not give you max leverage at 75%, but maybe we'll do 65 or 70%. And then maybe we'll do some good news dollars on the backside of the transaction once you have done all the hard, heavy lifting and you can prove up that you did these numbers. We'll give you some of your equity back in the form of good news dollars. So we have different ways of structuring transactions. Really, our purpose today is really to kind of listen to, a community banker. A lot of people don't have a relationship with the community banker. Community bankers are the ones that really probably do 95% of the business out there. They're the guys that are part of the Rotary Club, part of all the different clubs that are in and around the community. Build a relationship with them, kind of figure out what they like and what they don't like. Some things that I will tell you with the community banks, not everybody in the community banks are real estate lenders. Not everybody in the community banks like the specific area that you want to borrow money from. They may not like the asset. They may not like an asset at that age. They may not like an asset in that part of the town at that age with a flat roof, with a chiller system. So you kind of have to ask more questions. And when John says, and he's absolutely right, is when we get him on the front side of the transaction, he actually goes out with us and takes a look at the property to kind of figure out, does this kind of make sense for us? Does it make sense that something that when I bring it into credit committee that everybody is going to be thumbs up around the table? So, I want to make sure I'm telling you the best news up front because I've done this 100 times with this credit committee, that I have a good relationship with them. So I kind of already know what they're thinking and feeling before I bring the deal in. So anything more to add to that, John, at all?
I just think you're absolutely right at the point of going back to the home mortgage. The home mortgage guy, he sells that loan off to an investor, and that's probably the last you ever hear of him. With me, we hold it in our portfolio. It stays in my portfolio. I manage this on a day-to-day basis. I'm going to be the one calling you, asking you for updated financial information, ask you how the project's going. I'm also going to be the one that maybe some night is driving by the multifamily project just to make sure everything's going the way it should and there's no surprises for any of us.
And what are you guys requiring to get on paperwork? Talk a little bit about that, both on a new origination and an ongoing basis.
On a new deal, I like to see some historical financial numbers on the property, just as I guess the buyer would like to see how the project's done. If you're talking about a rehab project, I'm going to want to see what your pro formas are. I want to understand if you think you can increase rents by 20%, why do you think you can do that? Is there market data out there that helps support that number? Or is there something you're doing to the property that's going to help bring it up and make it better than the rest of the properties in the neighborhood? We're going to need to see personal financial statements and tax returns on the individuals. And then on an ongoing basis, probably depending on how seasoned the deal is, typically if it's a new deal, I'll probably the first couple of years ask for quarterly financial statements on it till my comfort level gets to a level to where I think this is a good deal. It's going the way it's being properly managed. Then I'll probably back off to an annual financial statement and annual tax returns and annual tax returns on my guarantors and annual personal financial statements. And that's just good, prudent banking on our part to make sure that have good assets on the books. But we also have a series of regulators that we have to answer to, and they're going to come in once a year and they're going to review that file and they're going to expect to see updated information on that.
Tell me a little bit about, we like apartment loans and we like office and retail. Back of a napkin, give me an idea what leverage would be on like an apartment transaction, class B or C property. What's the pluses and minuses? Generally,
the terms are, we like to see 30% equity in a deal. And again, there's going to be some variance on that. If I have a long-term customer, I might just go for 25% if I like the project and I'm really confident about the management in the deal. Banks differ on the amortization. I know some banks won't go longer than 20 years. I think we're willing to go 25 years on an amortization if we like the project. I hear rumors out there some banks will do 30 years, but I haven't seen it. And then from a cash flow standpoint, we're generally going to want to see cash flow coverage of at least 1.25 times, meaning if my payment's $10,000, I want your monthly cash flow to be at least $10,250. Did I do the math right?
No.
I was talking too fast there.
A little bit more than that.
Yeah.
125%.
$12,500.
$12,500. That's right. We need to have enough money to cover it. But during the times that we're doing the construction of the transaction is that sometimes we don't have cash flow. And that's where the strength of your balance sheet comes in. So if we can't rely upon the cash flow during the first 6 months or 12 months where you're rehabbing the property and you're about to get it to be stabilized to get to the 125, we'll allow it to go below the 125 for a short period of time, knowing that we're going to get up above 125 or 150 or 160 to get there. Talk about a little bit about interest only and talk a little bit about the regulators. Interest only is not a given. It's a gift for one thing. And also too, the regulators don't like interest only. And why is that, John?
They want to see performing assets. And by performing, they want to see that the property's generating its own cash flow and can support itself. But common sense would dictate to you if you're going to rehab a property, especially if you're going to take it down to the bare bones and do a complete redo, you're going to have a time period for that construction and then a time period to release the property up. And typically, if you think it's going to take 6 months for you to rehab the property, we'll probably give you 9 months for that rehab and then another 6 months to get up and running. The regulators, they like to see during that time period that you have cash reserves to pay the interest on that time period. So it's not uncommon for me to ask, okay, we're going to be interest only for a year here. I need you to put X amount of dollars in a special interest only account that I can draw that money from to pay the interest. And that helps us all when the examiners come through because they're going to ask me, well, where are you paying the interest from? And I can point to that account and say, well, it's coming from that account. And that kind of ends that conversation.
Yeah, regulators are real funny about that, is that when the transaction is under an interest only versus a fully amortizing loan that we're paying down the balance of the loan, regulators are in the position to protect grandma's deposits, and they want to reduce grandma's risk, making sure that she gets her deposits back with a little bit of a rate of return. But if interest only happens onto a loan transaction, is that we're not paying down the balance of the loan. And the regulators think that there's a perceived risk that we're not reducing the balance of the loan. And so they sometimes will say, well, if we continue on giving somebody interest only, that's kind of like a non-performing asset, and the bank has to put more capital aside, which means that their profits, that's money coming out of their net worth, they have to put that money aside, so they have less money to lend out. And so they're very sensitive and only try to give interest only to the best borrowers that have a perceived upside in the deal. They just don't want to do it just to tweak the rates of return for the investors. They want to make sure that it makes economic sense for grandma who lent them the money, and then to the bank who stands behind the deal that actually made the lending decision, and of course the ownership group that is holding that loan. Anything more to add to that at all?
No, I think just the interest holding period, there has to be a reason for it, rehab or release.
Listening here, John, it sounds like you have through the years seen all kinds of different, and I think you used the word earlier, unique situations. Is there just one that comes to mind to you that was either the most unique, potentially humorous, or the biggest surprise?
Probably the one that comes to mind, the story I always tell, and this happened early on in my career when I was still in Minneapolis, was I had a guy come in and he had a very well thought out plan. He had a binder put together that was a couple inches thick. He'd obviously spent a lot of time on this, but he wanted to buy the city of Duluth, and he just wanted to buy the whole city. And he had thought about it and thought prices were depressed, and if he could get a loan, he could make some money. So,
what kind of terms did you give him, John?
I took a pass on that deal, politely.
Well, some people do have bought cities in the past. I think it was Kim Bassinger that bought a city in Georgia or so, and that thing went south. So thank God that you didn't lend that guy the money for the city of Duluth.
Yeah, thank God I had to go ask somebody else. I didn't say yes.
Very good.
So if anybody is looking to get into the commercial real estate business, and 99 out of 100 people need commercial loans, is there any advice that you have for them on how to treat a banker to get the maximum results out of the relationship?
Well, I think the biggest thing is treat it like a relationship, and that we're a partner in this deal. And my job is to assess this deal, whether this is a good asset for the bank, a good asset for the borrower. And I have to then go convince other people that they agree with this. So the more information you can give me on a project, the better, and the more good quality information. I know sometimes sellers don't want to give you a lot of historical information, but the more you can get, the more it helps.
When you deal with companies like Old Capital and John, we're partners on a level. The borrower is the borrower, but for John and I, we're John's client. And so because we do so much business together, we kind of know how John likes to be treated. So if you have a transaction that you think John should take a look at, give us a ring, make sure that it makes sense. We'll discuss it with you in great detail. We'll get John into the mix if that's something that we think John should be brought into the transaction. Again, John is not a regional or even a national lender. They are a community lender, which means that he has lending authority pretty much, I would say, half the state, more of the state. How big of a lending footprint do you have?
Probably the greater DFW area.
So it's a little bit of a closed-end relationship where it's just going to be a regional area of Texas. And if you're not in the Texas area, build a relationship with the community bank in your neck of the woods. So anything more to add to that, Les?
The community banks have a tremendously strong presence in their community on all aspects of it. They're good partners to have when you're entering or want to expand in a certain community.
I'm just going to throw in my 2 cents for Old Capital. As a banker, I get a lot of brokers throwing packages at us all the time. I only take packages from 2 brokers, Old Capital and another one in Dallas. The reason for that is when I know I get a package from them, I know it's done right, I know the information is correct, and I know we're going to be able to work together.
I love that answer.
Thank you, John.
It's true.
All right. Well, we appreciate John coming in the podcast again today. Again, John is a community banker, and if you want to have a relationship or talk with him about a specific transaction that you want to work on, give us a call. We'll arrange the telephone call and put something together. Again, Les, thanks for being in the podcast.
Thanks for having me.
John, thanks for hanging out. We appreciate that.
Glad to be here.
All right. Have a good day. Thanks.
Thank you for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitallending.com to sign up for our weekly email updates. We'll see you here next week with another great interview.